Was JPMorgan Chase's trading blunder an isolated incident at a bank known for prudent risk management? Or could this be the first of many revelations by big banks who may not have learned their lessons? Mike Mayo, banking analyst at CLSA and author of Exile on Wall Street, joins me to discuss. Mike, thanks for coming. When you look at JPMorgan, one thing that kind of really stands out to me is that many people thought they were the smartest, if you will, or the best of the Wall Street banks. So what does this say about the rest of the industry?
Oh my, I agree. I think JPMorgan and their CEO, Jamie Dimon, is better than average, but it's a reminder that the largest banks might be too big to manage. Here they were taking actions to protect the bank, and it wound up hurting them. It's as if I took out an insurance policy on my house, and a month later I lose $100,000 on that policy. That was supposed to help us, protect us. And the other thing it's a reminder of that when Europe sneezes, some big banks can catch cold. So the combination of Europe and risk management and derivatives, you put them together, it's not a pretty picture.
Right. So for the average investor, a lot of people talk about how relatively cheap, either on earnings or book value, JPMorgan Chase and Citi, BofA, Goldman, et cetera, they may all be. Are they more value traps in your mind than true values, just because there's so much that we don't know about what's on their balance sheets?
Right now, I have negative ratings in all the big banks right now. I've had buys, I've had sells. Right now, I'm negative. So I'm not saying you never buy these banks, but you always have to understand that there's always information risk. There's always a black box nature to the big banks. So ultimately, you need to trust the systems, the processes, the managers running the bank. And do you trust them? And what you receive as a result of the JPMorgan trading loss is a little bit less trust for JPMorgan, and I would say a little bit less trust for the industry.
Right. Looking ahead, I mean, clearly you mentioned Europe, and obviously this was a big part of it. Do investors have to start worrying again like they were at the end of 2011 after MF Global had its spectacular collapse? That, at the end of the day, the $2 billion loss for JPMorgan, stock is down sharply Friday, but clearly it's something they can probably move on from. This isn't going to bring down the bank. Are you worried that there are other MF Global situations out there with some of the maybe mid-sized banks or even a larger bank?
I'm not so worried for the next week or month, though I would say I think we're seeing a deceleration in economic growth and you have additional political uncertainty. I'm extremely concerned for the next 5 to 10 years because the root causes that caused the financial crisis were built up over 20 years and they remain in place, and it comes down to faulty incentives. So what were the incentives for the traders and the managers overseeing the traders at JPMorgan? Because a lot of those incentives are faulty, not just at JPMorgan, but in the industry.
Right. To wrap up, can more regulation like the Volcker rule and other parts of Dodd-Frank really help? Or is this a case where the bank tried to hedge risk, failed, and you really can't regulate against bad trades? I mean, Jamie Dimon said that not everyone else out there may be as stupid as they were, but I think a lot of people are worried that, a lot of people are worried that maybe there are dumber people out there than JPMorgan.
You can't regulate away banks losing money, but what you can do is have principles that banks in the industry abide by, and you hold managers accountable for those principles. So we can have more regulation, but I prefer to see the shareholders exert more pressure and be allowed to exert more pressure on these boards of directors that oversee these companies and enforce principles as opposed to try to micromanage banks, which never works.